Imagine trying to navigate a foreign country without understanding the local language. You might see signs and gestures, but their true meaning would be lost on you. The financial markets have their own language, and for centuries traders have used a powerful visual tool to interpret it: Japanese candlestick charts. These charts are more than just simple price graphs. They're a rich visual representation of the battle between buyers, often called bulls, and sellers or bears over a specific period. Each candle tells a story of greed, fear, indecision, and conviction, offering clues about where the price might be headed next. Learning to read these patterns is like becoming fluent in the market's native tongue, giving you a distinct advantage. Each individual candlestick provides 4 key pieces of information: the opening price, the closing price, the highest price, and the lowest price for a given time frame. The main rectangular part of the candle is called the real body, which represents the range between the open and close. If the close is higher than the open, the body is typically colored green or white, indicating buying pressure. If the close is lower than the open, it's colored red or black, showing selling pressure. The thin lines extending above and below the body are called shadows or wicks. These shadows represent the highest and lowest prices reached during the period, illustrating the full extent of the session's volatility and price rejection at certain levels. The true power of candlestick analysis, however, emerges when you start to recognize specific patterns formed by one or more candles. These patterns aren't random, they're recurring formations that have been observed and cataloged over hundreds of years, reflecting market psychology in action. They can signal a potential reversal of the current trend, a continuation of the trend, or a period of indecision and consolidation. For a trader, these patterns act as signposts, highlighting critical moments where the balance of power between buyers and sellers might be shifting. This knowledge allows you to anticipate potential market moves, rather than just reacting to them after the fact. Before we delve into specific patterns, it's crucial to understand that candlesticks are a tool, not a crystal ball. They provide probabilities, not certainties. Their effectiveness is greatly enhanced when used within the broader context of the market trend and in conjunction with other forms of technical analysis, such as support and resistance levels, trend lines, and volume indicators. Think of them as a crucial piece of a larger puzzle. By learning to interpret these visual cues correctly, you can make more informed trading decisions, manage risk more effectively, and improve your overall understanding of market dynamics. This guide will walk you through the most important patterns, from simple single candle signals to complex multi-candle formations. When a market has been in a sustained downtrend, traders are constantly searching for signs that the selling pressure is exhausting and that buyers are beginning to step in. Bullish reversal patterns are the signals that suggest this shift may be underway. One of the most classic single candle patterns is the hammer. It's identified by its small, real body located at the top of the trading range, with a long lower shadow that's at least twice the size of the body and little to no upper shadow. This structure tells a compelling story. During the session, sellers pushed the price significantly lower, but a powerful wave of buying pressure emerged, driving the price all the way back up to close near its opening level. This indicates that the bears lost control. Another important single candle bullish pattern is the inverted hammer. As its name suggests, it looks like an upside-down version of the hammer. It appears during a downtrend and features a small real body at the lower end of the trading range with a long upper shadow and a very small or non-existent lower shadow. The psychology here is slightly different but equally significant. It shows that buyers attempted to push the price higher during the session, but sellers managed to push it back down. However, the fact that buyers showed such strength after a prolonged decline is a potential warning sign for sellers. Confirmation for both the hammer and inverted hammer is vital. Traders often wait for the next candle to close above the high of the pattern to confirm the bullish reversal. The bullish Marubozu is perhaps the most straightforward and powerful single candle bullish signal. The word Marubozu means bald head in Japanese, which perfectly describes this candle. It's a long green or white real body with no upper or lower shadows. This pattern indicates that buyers were in complete control from the moment the market opened to the moment it closed. The price opened at its low and closed at its high, demonstrating relentless buying pressure throughout the entire session. A bullish Marubozu appearing after a decline, especially on high volume, is a very strong indication that the trend has reversed and a new uptrend is likely beginning. It signals extreme bullish sentiment. For all these bullish patterns, confirmation is not just a suggestion, it's a critical step in the trading process. A single candle, no matter how compelling, is just one piece of data. A trader looking at a hammer pattern should wait for the next period's candle to form. If that subsequent candle is a strong bullish candle that closes decisively above the high of the hammer, it provides strong confirmation that the buyers have indeed taken control. This practice of waiting for confirmation helps filter out false signals and increases the probability of a successful trade. It transforms a potential signal into a more actionable trading setup, adding a layer of discipline to your strategy. While single candles can provide powerful signals, patterns formed by 2 or 3 consecutive candles often tell a more detailed and reliable story about market sentiment. One of the most significant 2-candle bullish reversal patterns is the bullish engulfing pattern. This formation occurs at the end of a downtrend and consists of 2 candles. The first candle is a small bearish red or black candle continuing the prior trend. The second candle is a large bullish green or white candle whose real body completely engulfs the real body of the first candle. This pattern visually demonstrates a dramatic and sudden shift in momentum from sellers to buyers, suggesting a strong potential for a price reversal to the upside. Another key 2-candle bullish pattern is the piercing line. This pattern also appears after a downtrend and signals a potential bottom. It's composed of a bearish candle followed by a bullish candle. The bullish candle opens below the low of the previous bearish candle but then rallies strongly to close above the midpoint of the first candle's real body. The deeper the second candle pierces into the body of the first, the more significant the pattern is considered. The piercing line shows that despite a bearish start to the session, the gap down, buyers stepped in with enough force to overwhelm the sellers and recover more than half of the previous day's losses, a clear sign of newfound strength. Moving to 3-candle formations, the morning star is a classic and highly reliable bullish reversal pattern. It unfolds over 3 periods at the bottom of a downtrend. The first candle is a long bearish candle reflecting the continuation of the selling pressure. The second candle is a small-bodied candle. It can be bullish, bearish, or a doji that gaps down from the first, indicating market indecision. The third candle is a strong bullish candle that closes well into the body of the first bearish candle. This sequence illustrates a clear transition from bearish dominance to a moment of equilibrium, and finally to bullish control, making it a powerful signal for a new uptrend. The 3 white soldiers pattern is a bullish reversal or continuation pattern that signals undeniable strength. It consists of 3 consecutive long-bodied bullish candles, each closing progressively higher than the last. Ideally, each candle should also open within the real body of the previous candle and close near its high, indicating that buyers are in control throughout each session with minimal selling pressure. This staircase-like formation is a very strong visual representation of a steady and powerful shift in market sentiment. When it appears after a period of consolidation or at the end of a downtrend, it often marks the beginning of a significant and sustained move higher. Just as bullish patterns signal potential bottoms, bearish patterns warn of potential tops, indicating that a period of buying enthusiasm may be coming to an end. These patterns are crucial for traders looking to take profits on long positions or initiate new short positions. One of the most common single-candle bearish reversal patterns is the shooting star. It's the mirror opposite of the hammer and appears during an uptrend. It's characterized by a small real body at the lower end of the trading range, with a long upper shadow that's at least twice the length of the body and little to no lower shadow. This formation reveals that buyers tried to push the price higher, but sellers overwhelmed them, forcing the price back down to close near the open. The bearish Marubozu is the counterpart to the bullish version and is an extremely potent bearish signal. It's a long red or black candle with no upper or lower shadows, meaning the price opened at its high and closed at its low. This indicates that sellers dominated the market from the opening bell to the closing bell, with no significant pushback from buyers at any point during the session. When a bearish Marubozu appears after a sustained uptrend, it signifies a dramatic and decisive shift in momentum. It suggests that the bullish sentiment has completely evaporated and has been replaced by aggressive selling pressure, often heralding the start of a new downtrend. Confirmation for these single-candle bearish patterns is just as critical as it is for their bullish counterparts. A trader who spots a shooting star at the top of an uptrend should exercise patience and wait for the next candle to validate the signal. If the following candle is a bearish candle that closes below the low of the shooting star, it provides strong confirmation that sellers have indeed seized control of the market. This confirmation helps prevent traders from acting on a false signal that might just be a temporary pause in the uptrend. It adds a layer of objective verification to the subjective art of pattern recognition, which is essential for consistent trading. Understanding the psychology behind these patterns is key. The shooting star, for instance, is a visual depiction of rejection at a higher price level. The market tested new highs, but the sellers were strong enough to reject those prices and push the market back down. This failure to hold gains is a significant warning sign for the bulls. Similarly, the bearish Marubozu shows no hesitation from the sellers. It's a statement of intent. By learning to identify these single-candle warnings, traders can become more adept at recognizing when a market's upward momentum is fading and a reversal is becoming more likely, allowing them to protect their capital and capitalize on new opportunities. When multiple candles combine to form a bearish pattern, the signal is often considered more reliable since it represents a more prolonged struggle between buyers and sellers, where the sellers ultimately win. The bearish engulfing pattern is a prime example of this and stands as a powerful two-candle reversal signal at the top of an uptrend. It begins with a bullish or green or white candle that continues the prevailing trend. This is followed by a large bearish or red or black candle whose real body completely envelops or engulfs the real body of the preceding bullish candle. This pattern visually demonstrates that sellers have stepped in with overwhelming force, completely reversing the gains of the prior session and signaling a major shift in market control. Another important two-candle bearish reversal pattern is the dark cloud cover. This formation also appears during an uptrend and signals a potential peak. It consists of a strong bullish candle followed by a bearish candle that opens above the high of the first candle, so a gap up, but then closes deep within the body of that first bullish candle, ideally below its midpoint. The initial gap up lures in more buyers, but the subsequent sell-off and deep close show that sellers have taken firm control. The failure to sustain the new highs is a significant sign of weakness, and the deeper the second candle penetrates the first, the more potent the bearish signal becomes. The three-candle evening star pattern is the bearish counterpart to the morning star and is a highly regarded reversal signal. It forms over 3 sessions at the end of an uptrend. The first candle is a long bullish candle reflecting strong buying momentum. The second candle is a small-bodied candle, bullish, bearish, or even a doji, that gaps up, showing a potential exhaustion of the trend and a moment of indecision. The third candle is a strong bearish candle that closes well into the body of the first bullish candle, confirming that the bears have taken over. This sequence, from bullish conviction to hesitation to bearish dominance, paints a clear picture of a market top. Finally, the three black crows pattern is a formidable bearish reversal signal. It consists of 3 consecutive long-bodied bearish candles that close progressively lower, often resembling a staircase moving down. Ideally, each candle opens within the real body of the previous one and closes near its low, showing relentless selling pressure throughout each of the 3 sessions. This pattern signifies that the sellers are firmly in control and that the sentiment has shifted decisively from bullish to bearish. When this pattern appears after a significant uptrend, it often marks the beginning of a prolonged move to the downside, serving as a clear warning to any remaining bulls. Not every candlestick pattern signals a clear reversal or continuation. Some indicate a pause, a moment of equilibrium, or a period of intense indecision in the market. These neutral patterns are equally important because they alert traders that the current trend is losing momentum and a change could be on the horizon. The most famous of these is the doji. A doji is a candle with a very small or non-existent real body, meaning the opening and closing prices are virtually the same. It looks like a cross or a plus sign. A doji signifies a perfect stalemate between buyers and sellers. Despite volatility during the session, which is shown by the shadows, neither side could gain control by the close. There are several variations of the doji, each with a slightly different nuance. The long-legged doji has long upper and lower shadows, indicating significant volatility and indecision. The gravestone doji has a long upper shadow and no lower shadow, showing that buyers pushed prices up, but sellers forced them all the way back down to the open, which is a potentially bearish signal at a top. Conversely, the dragonfly doji has a long lower shadow and no upper shadow, indicating sellers pushed prices down but buyers brought them all the way back up to the open, a potentially bullish signal at a bottom. The four-price doji, where open, high, low and close are all the same, shows ultimate inactivity and indecision. Similar to the doji is the spinning top. This candle also has a small real body, but unlike a doji, it is clearly discernible. It is characterized by long upper and lower shadows that are much larger than the body itself. Like the doji, the spinning top represents indecision. The long shadows show that both buyers and sellers were active and fought for control, but neither could secure a decisive victory by the end of the session. A spinning top appearing after a strong uptrend or downtrend indicates that the dominant force, buyers or sellers, is losing conviction, and the market could be preparing for a change in direction. It is a signal to be cautious and watch for the next candle for confirmation. Another important indecision pattern is the inside bar. This is a two-candle pattern where the second candle is completely contained within the high and low range of the preceding candle, which is often called the mother bar. The inside bar represents a contraction in volatility and a period of consolidation. The market is taking a breather after a strong move. Traders watch this pattern closely because a breakout from the mother bar's range can often signal the continuation of the prior trend. A break above the mother bar's high is a bullish signal, while a break below its low is a bearish signal. These neutral patterns are warnings that the market is at a critical juncture, and traders should be prepared for the next move. Beyond the standard reversal and continuation patterns, there are more nuanced multi-candle formations that can provide traders with deeper insights into market psychology. One such pattern is the harami, which is the Japanese word for pregnant. The harami is a two-candle pattern that can be either bullish or bearish, and is essentially the opposite of an engulfing pattern. A bearish harami occurs at the top of an uptrend, and consists of a large bullish candle followed by a small bearish candle whose body is completely contained within the body of the first candle. This signifies a sudden stop in momentum. The small bearish candle indicates that the buying power has abruptly dried up, signaling indecision and a potential reversal. The bullish harami is the counterpart that appears at the bottom of a downtrend. It begins with a large bearish candle, followed by a small bullish candle that is completely engulfed by the body of the first candle. Similar to its bearish cousin, this pattern signals a sudden halt to the prevailing trend. The selling pressure that created the first large candle has suddenly dissipated, and the small bullish candle suggests that sellers are losing control, and buyers might be tentatively stepping in. While the harami is not as strong a reversal signal as the engulfing pattern, it serves as an important early warning that the current trend is losing steam and traders should be on alert for a potential change. Another powerful set of two-candle reversal patterns are the tweezer top and tweezer bottom. A tweezer top formation occurs at the end of an uptrend and consists of two or more candles with matching or nearly matching highs. The first candle is typically a strong bullish candle, and the second candle reverses to close lower, confirming the resistance at that peak. This pattern shows that the market tried to push higher on two separate occasions, but was rejected at the same price level both times. This double failure to break higher is a strong indication that the bulls have exhausted themselves, and sellers are defending that price level vigorously, often leading to a sharp reversal. Conversely, the tweezer bottom pattern forms at the end of a downtrend and consists of two or more candles with matching or nearly matching lows. The first candle is typically bearish, and the second candle reverses to close higher, demonstrating strong support at that price level. This pattern visually represents the market testing a low point and finding significant buying interest not once but twice. This successful defense of a support level shows that buyers are stepping in with conviction, absorbing all the selling pressure. The tweezer bottom is therefore a reliable signal that the downtrend may be over and a new uptrend is about to begin. These advanced patterns add another layer of sophistication to a trader's analysis. Mastering candlestick patterns involves more than just memorizing their shapes. It requires understanding how to use them effectively within a broader analytical framework. The single most important rule is to always seek confirmation. A pattern is a signal of probability, not a guarantee of a future outcome. For a bullish reversal pattern like a hammer, confirmation comes when the next candle closes above the hammer's high. For a bearish pattern like a shooting star, confirmation is a subsequent candle closing below its low. This simple act of waiting for one more period can significantly reduce the number of false signals you act upon, instilling discipline and patience into your trading routine. Context is king in technical analysis. A candlestick pattern does not exist in a vacuum. Its significance is determined by where it appears. A hammer pattern is a powerful bullish signal, but only if it forms after a prolonged downtrend and at a key support level. The same pattern appearing randomly in the middle of a choppy sideways market holds very little meaning. Always analyze the prevailing market trend and identify major support and resistance zones before giving weight to any candlestick pattern. The most reliable signals occur when a classic pattern forms at a historically significant price level, creating a convergence of evidence that strengthens the case for a trade. Another crucial element for confirmation is trading volume. Volume measures the number of shares or contracts traded during a period and reflects the conviction behind a price move. A reversal pattern that forms on high or increasing volume is far more significant than one that forms on low volume. For example, a bullish engulfing pattern accompanied by a massive spike in volume shows that a large number of participants were involved in the reversal, adding immense credibility to the signal. Low volume during a pattern formation might suggest a lack of interest or conviction, making the signal less reliable. Always check the volume bars at the bottom of your chart to validate the strength of a candlestick pattern. Finally, candlestick patterns should not be used in isolation. They are most powerful when combined with other technical indicators that can confirm their signals. For instance, if you spot a bearish engulfing pattern at the top of an uptrend, you could check an oscillator like the Relative Strength Index, or RSI. If the RSI is showing a bearish divergence, meaning price makes a new high but the RSI makes a lower high, it strongly corroborates the candlestick signal. Similarly, using indicators like moving averages or the MACD can help confirm the trend direction and momentum shifts suggested by the candles. Combining these tools creates a robust, multifaceted approach that improves the quality of your trading decisions. Throughout this guide, we have journeyed through the visual language of the market, from the simplest single candle signals to more complex multi-candle formations. We have seen how patterns like the hammer and bullish engulfing can signal the dawn of a new uptrend, while patterns like the shooting star and evening star can warn of an impending downturn. We also explored the importance of indecision patterns like the doji and spinning top, which represent critical pauses in the market's narrative. Each of these patterns tells a story about the psychological battle between buyers and sellers, offering invaluable clues to the observant trader who knows how to listen. However, the key takeaway is that recognizing these patterns is only the first step. True mastery comes from integrating this knowledge into a disciplined and comprehensive trading strategy. The principles of confirmation are not optional guidelines, they are essential rules for survival. Waiting for the next candle to validate a signal, checking for increased volume to confirm conviction, and ensuring the pattern appears within a logical market context are all critical filters that separate high-probability setups from market noise. Without these layers of verification, a trader is merely gambling on shapes rather than making informed analytical decisions. Furthermore, the most successful traders understand that no single tool provides all the answers. Candlestick patterns are most effective when they are part of a symphony of analytical tools. Combining candle signals with support and resistance levels, trend lines, moving averages, and momentum oscillators like RSI or MACD creates a much richer and more reliable picture of the market. When a bullish candlestick pattern forms at a long-term support level and is confirmed by a bullish divergence on the RSI, the probability of a successful outcome increases dramatically. This confluence of signals is what traders should always seek before risking their capital. In conclusion, Japanese candlestick charting is a timeless and powerful method for analyzing market behavior. It provides a window into the sentiment and momentum of the market that is more intuitive and detailed than simple line or bar charts. By learning to identify the key patterns and, more importantly, by applying the disciplined principles of confirmation and confluence, any trader can enhance their ability to anticipate market turns and improve their decision-making process. Think of candlesticks not as a standalone system but as an indispensable component of your analytical toolkit, helping you to read the market story and trade in harmony with its rhythm.